It's a common strategy or goal to be able to just live off of the interest and dividends that your portfolio provides by the time that you reach retirement age. It can provide a sense of security or safety knowing that you don't have to sell any investments or dip into your principal. But in this video, I'm going to explain a few reasons why this strategy might be costing you more than you think. Make sure you stick around to the end of the video where I explain a few alternative approaches that I use as a financial planner that addresses each of these issues. Hey everyone, if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. This channel and my firm are dedicated to giving you more confidence and clarity with your money. First issue that I have with aiming to only live off of dividends of your portfolio is that it introduces a bias towards high dividend investments. The dividend rate of the S&P 500 is less than 2%. So for example, if you have $1 million and you only want to live off the dividends by investing in an S&P 500 fund, that's going to provide you less than $20,000 in income per year. So the natural next step for most investors would be to seek a higher dividend investment, whether it be stocks or ETFs. One of the issues with this is that it could lead to an under-diversified portfolio. Generally speaking, a well-balanced portfolio should have a mixture of growth-oriented investments as well as value-oriented investments, which are ones that typically pay a dividend. So anytime that you exclude an asset class, in this case it would be those growth investments, it can actually lead to more risk. One of these risks would be that the companies that you invest in end up cutting their dividend. Some people forget sometimes that dividends are not guaranteed by a company. They can cut them at any time, and often is the first thing to happen, as we have seen in COVID. When companies come under some sort of financial distress. So unless you're investing in mutual funds or ETFs that have hundreds, if not thousands of different dividend paying companies in them, leave yourself exposed to that risk that those dividends could be turned off at any time. Another risk to be aware of is that a company that has a high dividend yield could mean that it's in financial distress. To explain this further, let's say that you have a company with a stock price of $100 per share, and over the past several years, it's paid out $2 per share as a dividend. This would mean that their dividend yield is 2%. Well, let's say that this year there's a news report that comes out that says the company is under financial distress, unable to pay its debts back, whatever it might be. Well, this news causes the stock price to drop to $50. All of a sudden, assuming that the dividend has not been cut completely, the dividend yield is now 4%. So again, a higher dividend yield in this situation could mean that the company is in financial distress relative to its peers. So to summarize this first point, by aiming to live off of the dividends in your portfolio, it could introduce biases and risks that would otherwise be reduced by having a more diversified portfolio. The second issue with aiming to live off of only the dividends of your portfolio is that dividend paying investments may not be the most tax efficient investments depending on your situation. So companies can pay one of two types of dividends. It can be a qualified dividend or a non-qualified dividend. A qualified dividend means it would be taxed at preferential tax rates similar to long-term capital gains, as opposed to ordinary income, which is how non-qualified dividends are taxed. So first, definitely do your research to see what type of dividend a company pays if you're going to invest in a company because of that. Another reason that dividends are not as tax efficient as you might think are that you receive dividends on a set schedule that you don't really have control over. So most companies typically pay a dividend on a quarterly basis, which means outside of retirement accounts, you're also receiving a taxable event on a quarterly basis. Compared to being able to sell investments at a gain or a loss, you have more control over when that taxable event is. And again, by utilizing capital gains and losses by selling your investments, you also have more control over what your total tax liability will be by selling specific investments to offset one another. Not to mention that if you're still in the accumulation phase and saving towards retirement, high dividend paying investments could drag down the returns of your portfolio because of the taxes that you have to pay each year, rather than more growth oriented investments that may have less of a tax liability as time goes on. Before we continue, if you're finding this video helpful at all or you've learned anything new, let me know by leaving a comment below and subscribing to the channel for future videos. The last issue that I personally have with only living off the dividends of your portfolio, as a financial planner, it can lead to underspending and ultimately regret later in life. So for this, I just want to bring up a brief case study and show you what I mean by underspending. So just to explain what I mean when I say that living off the dividends of your portfolio only can lead to underspending, I want to show you a really high level case study. Some of you might remember Jamie from a previous video. This is a client of ours. I've changed some of the numbers on a duplicate profile. And again, this is not her real name, but just to give you a better visual into this issue that I have. We have a snapshot of Jamie here. She's 59 years old. She has about $1 million between all of her investment accounts. She has her home as well, which is bringing her net worth up, but that's obviously not money she's going to live off of in retirement. So she has a $600,000 401k that's pre-tax, a Roth IRA with $120,000, and a brokerage account, which is $280,000. So for this case study, we're going to assume that Jamie's accounts are invested at approximately 60-40, so about 63% in stocks, 37% in bonds, which is a pretty common allocation for a retiree to have. And then we're also going to assume that the dividend yield of her portfolio is about 3%. This is pretty in line with what a typical 60-40 portfolio would spit out as far as interest and dividends. Again, we're going to assume that she does not want to touch any of her principal as someone who wants to live off of only the dividends of her portfolio. So basically 3% of $1 million will come out to $30,000 per year that Jamie wants to live off of. She'll also have Social Security, but for the purposes of this video, we're just going to assume that her Social Security is going to cover her other fixed expenses like property taxes, homeowners insurance, and health insurance, things like that. So again, $2,500 per month or $30,000 per year is what she would be drawing from her portfolio by only living off the dividends, as we've been talking about. So this is Jamie's retirement analysis using these figures that we've just discussed. This is basically 1,000 different scenarios of what could happen over the rest of her life, which is until age 90 in this example. So a 100% probability of success here means that out of those 1,000 different scenarios over the next 30 years, not one of them results in Jamie running out of money. Now, initially, you might think this is a good thing. Obviously, nobody wants to run out of money in retirement. But the issue here, if you look a little bit deeper, is that it not only results in her not running out of money, but it also results in her likely reaching the end of her life with a lot more money than she even started retirement with. So to show this, we can go to this confidence tab here. This is a kind of a compilation of all 1,000 different scenarios. Median scenario, in other words, not the best, not the worst of different market returns that could happen over the next 30 years. She has $2 million left in her portfolio. So she started retirement at 62 with $1 million. She's reaching the end of her life with $2 million. So again, by only spending the dividends in her portfolio in this example, it leaves the possibility of Jamie reaching the end of her life with a ton of regret, a ton of missed maybe travel, missed experiences early on in her more active years of retirement. So this is what I mean when I say that only living off your dividends could leave the possibility of underspending and regret over your retirement. And just to be very clear here, if you do have a legacy goal where you want to leave a certain amount of money to the next generation or a family member, then that's obviously a very common goal as well. But what we don't want is to unintentionally reach the end of our lives with regret and wishing we spent more of our money earlier in our lives. So again, I do work with clients often that have a specific goal to set aside money for the next generation, but do that intentionally and not unintentionally. So as a financial planner, one thing that I would go and say to Jamie in this situation is kind of show her what she could potentially be spending, especially in her early years of retirement, that could lead to a more fulfilling retirement, more fulfilling life for her. So what I like about this is that we can show her how much more she could possibly be spending without still a significant chance of running out of money. So if we up her spending to, let's say, $4,000 per month, we can see that she's still at a 79% probability of success, which is something that I'm pretty satisfied with. Again, as a planner, I like to see 75, 80% in most cases, depending on the individual and what they're comfortable with. But the way that I like to frame this is that 79% of those scenarios result in her not running out of money. But the assumption here is that no adjustments are made along the way. So what I like to say it as, if you've seen my videos before, you know this, but there's a 21% chance that we're going to have to adjust something, at some point in her retirement. So if we start going down one of those paths where we're depleting her portfolio faster than we should, we can always cut back spending again, for example, $3,500, and that will boost her probability of success right back up. So again, that probability of success can be misleading. I typically like to frame it as probability of adjustment on the opposite side of that percentage. So as promised, I wanted to touch on a couple alternative approaches that address each of these issues that I have with only living off the dividends of your portfolio. With the first alternative addressing that bias of investing in high dividend stocks, I think most financial advisors and just prudent DIY investors alike would agree that a well-diversified portfolio should consist of a balance between both growth and value-oriented companies, value being typically those companies that will pay more dividends, small, medium, and large-sized companies as opposed to just big companies that a lot of people gravitate to in the S&P 500, and then also a healthy balance of domestic and international stocks, and then also bonds, of course, as well. So that's what I'll say about trying to avoid that bias towards only those high dividend stocks. Again, this is not specific advice, but just something to think about. Regarding the second point about a more tax efficient method of investing, especially if you're still in that accumulation phase, again, not quite at retirement yet, Any dividend paying investments or high dividend paying investments, consider putting those into your tax advantage retirement accounts like IRAs and Roth IRAs, since you will not owe taxes on them as you go, and you can just reinvest the dividends in those accounts without any tax implications. And then put your more tax efficient investments like your growth oriented companies or municipal bonds that don't have taxable interest in those brokerage accounts so that you're maximizing your tax efficiency of your overall portfolio. Another approach that may be more tax efficient, again, is to utilize a total return strategy with your investments. So rather than just focusing on the income from dividends, make sure your investments are balanced towards both growth and income. And remember that being open to selling your investments for your retirement income needs can allow you to utilize tax loss harvesting and control when you pay your capital gains on other investments. And lastly, to address the issue of underspending that this strategy introduces, an alternative that I like to use as a financial planner is called retirement income guardrails. What's unique about guardrails is that it sets rules to allow you to increase your withdrawal amounts if your portfolio is growing in value, like it typically does over long periods of time, whereas other spending strategies like dividends or the 4% rule don't really have any sort of guidance around increasing your income to prevent you from reaching the end of your life with a big pile of cash in the bank. So that's what I like about guardrails. If you want to learn more about that, I have made other videos. I'll put some of them on the screen for you now. As always, visit us at sparkwealthadvisors.com if you're interested in learning more about what we do. Subscribe to the channel, and we'll see you in the next video.